Nouriel Roubini of Roubini Macro Associates looking ahead to the new year and writing this. Some of Trump's policies will increase growth and reduce inflation, while others could be stagflationary. So the impact on growth, inflation and on markets depends on how much of the former versus the latter. Nouriel joins us now for more. Nouriel, wonderful to see you, sir.
Great seeing you.
How difficult does it make it to look ahead to next year with any real clarity, to come up with some kind of outlook when things are so difficult?
There's a lot of policy uncertainty. As I pointed out, some of the economic policies of Trump may increase over time growth, reduce inflation, being overall pro-business, keeping tax rates on capital and labor low, deregulating the economy, and things like increasing the production of fossil fuels and pushing down the prices of energy. Probably also this Dodge initiative over time may increase economic efficiency and so on. So those are the positives. And over time, they could increase growth, they could reduce inflation. But we know there are some sets of other policy. We don't know how much they're going to be implemented. They will increase inflation and potentially be stagflationary. In my view, tariffs are inflationary. Protection is the risk of an economic war with China. First, draconian restriction to migration, if not a mass deportation. If we have unfunded fiscal deficits and the promises imply $8 trillion of deficits additional over the next 10 years, that's going to crowd out growth by increasing interest rates, nominal and real, and the bond market vigilantes are going to wake up. If you try to disorderly weaken the dollar, that could be inflationary, and if you interfere with independence of the Fed. Now, I think on the positive side, I think there are a number of factors that are going to constrain the bad policies. One is market discipline. If you follow policy inflationary, then bond market vigilantes are going to wake up, bond yields are going to go higher, the stock market is going to correct, and he cares about the bond market, he cares about the stock market. Secondly, Fed independence. If he follows policies that lead to inflation, the Fed may not continue to cut rates next year, may even raise rates if inflation were to be going higher. And also policy choices. As you pointed out, on one side you have people like Scott Bessent who want to escalate, de-escalate on tariffs, and others who are total trade hawks on trade and on China, like Peter Navarro. So it depends on the balance between who's going to be in power.
Let's unpack some of that and pick out tariffs. Big debate already so far this morning. You've heard some of it. Please weigh in. If it's targeted, could it be a good thing for the American economy?
Well, if it's targeted, I would say that the impacts on inflation are going to be modest, and maybe some of the reshoring that already is occurring is going to continue. And there'll be actually pressure on our trade partners to say, if you don't want tariffs, you have to bring more investment, semiconductors, autos, EVs, you name it, to the United States. So that's the escalate in order to de-escalate. But I would say the higher those tariffs become, the more there's an impact on import prices, the more there's an impact on inflation, and the more there is global fragmentation. There's also the risk, of course, of trade wars, of our trade partner retaliating against the United States. If that occurs, the impact on growth is going to be more negative, the impact on inflation is going to be higher. Depends on the size of these tariffs. If it's Navarro types of policies on trade, it's stagflationary. If it's escalate to de-escalate, maybe the impact on inflation is modest and the negative impact on growth is also modest.
So some people are arguing that we're in this wave of deglobalization that basically reverses some of the disinflationary forces of the 3 decades following really the mid-'80s. I'm wondering whether that's actually true, whether that's what we're seeing, because there still is quite a bit of trade. It's just going different routes. And frankly, you could see that overproduction from places like China are going to lower prices in certain places, even if they don't in the U.S. if their wall's up. In other words, are we overestimating the inflationary impact on a dramatic level of a lot of these tariffs?
Well, the impact of high tariffs on the United States would be inflationary. But if you think about the impact on growth and inflation in the rest of the world, will be disinflationary. Because if there is a shock to the demand for the exports of Europe, Asia, China, then there'll be excess supply. Growth is weakened in those parts of the world, and that leads to disinflation in the rest of the world. So the impact on the US of high tariff is inflationary. The impact on the rest of the world is disinflationary because of excess supply.
You used to be called Dr. Doom. Are you retiring that mantle?
I always said I'm not Dr. Doom, I'm Dr. Realist. There are plenty of upside in economic growth. And by the way, some of them I think are more secular. I think the impact of technological innovation implied that potential growth in the US by the end of the decade could be close to 3%. And the fact we already have seen for the last couple of years growth of 2.5 to 2.8% with inflation falling is a sign that maybe productivity growth is increasing and potential is increasing and we can grow faster with having lower inflation. So I'm not Dr. Doom.
Well, when it comes to tariffs, just to go back to this idea of the personnel, we know what Jameson Greer as well thinks about China. In a hearing to Congress, he had talked about strategic decoupling. Do you expect that over the next 4 years between Beijing and Washington?
Yes, I do. I think that one of the biggest risks is not just tariff in general, but a broader economic war against China. If you listen to the long list of complaints of the Trump administration, they say China has been free riding on international trading system, tariff, non-tarifary barriers, government procurement policies, FDI policies, intellectual property rights, and of course fentanyl and lots of other things. And also geopolitically, there may be an attempt to try to contain the rise of China. So the biggest risk is not just tariff on China, but how much the overall policy toward China is going to be confrontational. And if they feel that we're trying to contain the rise, they could become quite aggressive themselves.
Well, front page of the FT today is talking about these 4 government-backed authorities that are telling local chip companies that you can no longer buy silicone from the United States. They're no longer safe or reliable. Are we already in this moment you're describing?
Well, certainly in anything to do with high tech, we've started already in the Biden administration to be in a process of decoupling, restriction to exports, both of semiconductor and semiconductor equipment, restriction to anything that's related with AI and high technology. Under Biden was a narrow yard and high fences and stuff that was supposed to be critical. So de-risking, I think that in the case of Trump administration, we may move from de-risking with China to decoupling with China. There's something much more severe.
Does Europe need to pick a side?
They'll be in a very, very tough position because geopolitically, Europeans are close to the United States, NATO, and so on, but they do a lot of trade and investment with China. Under the Biden administration, it was easier because there was a compromise within the G7 about de-risking as opposed to decoupling. If the U.S. goes towards decoupling and says Europeans have to follow us, otherwise, there are consequences, not just on trade, but also on NATO, security, and you name it, then I think Europe is already weak, will be in a tougher spot.
How much worse could things get for the Europeans? We've been saying through this morning that France is ungovernable at the moment, which means it can't deliver reforms. And you know, in Europe, things have to get worse before ultimately they find solutions. How much worse does it need to get?
Well, things are really pretty bad already in Europe. I think that potential growth is below 1%. In Europe, Europe is going to be in the Eurozone less than 1% next year. So, and structural reform are not going to occur anytime soon. There's a fragmentation between these 27 countries. Some of them want more integration, some of them want less. At the core of Europe, Germany and France are going to be politically unstable. So I don't see either the Letta report or the Draghi report for more integration, for a common market, for more productivity and competitiveness being implemented. So it looks pretty dark for Europe right now.
Which is the reason why I'm surprised that so many people come in and they say it's priced in. We don't really see a path out of here. We don't necessarily see an economic engine or the political will or capability to really counter it. At what point are we facing off with a potential dollar shock? And I ask this because, yes, the euro is likely to stay around here or weaken further, but what if it actually weakens dramatically as the ECB is forced to cut rates and that divergence widens?
Well, there are many good reasons why the dollar may continue to strengthen. One is, of course, tariff. If they reduce the trade deficit, it's going to strengthen. 2, Trump had said, I want to have actually the dollar at the center of the global reserve system, and therefore that implies you want strong dollar than a weaker dollar. Relative growth differential, relative monetary policies, the fact that the U.S. is innovating and capital is flowing into the U.S. capital markets and the stock market all imply that the dollar over time should become stronger, the euro and other currencies should become weaker. The problem, however, is that Trump says a strong dollar has led to deindustrialization, to American carnage, people free riding on us, to having large trade deficit, and we want at some point a weaker dollar. The fundamentals imply a stronger dollar, but policy there may be an attempt eventually, maybe in the second half of the administration, to find an agreement on currency, maybe to say either you accept 10% tariffs or you accept a 10% depreciation of the dollar. I would not rule out there'll be some big Mar-a-Lago agreement. These FX agreements are always in a resort. Bretton Woods,
a Mar-a-Lago Accord,
Plaza, Louvre, and so on. So a Mar-a-Lago Accord is something that they're going to think about. Not in the first 2 years, but down the line, they're going to say to the trading partners, you don't want tariffs, you have to do other things for us.